Good morning, Chris. How are you?
I'm fantastic, Anthony. You look terrific. For those of you listening, he has a top hat on.
Oh, I forgot I had that.
Like cheese.
I sleep in this. I forgot to take it off.
Yeah, I get it. It's a sort of like the cheese head thing that you get in Wisconsin, which relates to our guest today, but it's a top hat, which really fits you because I think when I think of you, I think you're really a top hat and monocle sort of guy. You remind me of the guy from Monopoly.
Yeah, or that's a James Bond villain, one of the two, or Mr. Peanut. Yeah.
Mr. Peanut. All right, here's the question: who's the top hat wearer? I'm going to say Abe Lincoln. Abe Lincoln wins for best top hat. He pulled it off.
You did. I've got a really bad cheese dad joke for you.
Okay, let's hear it.
What's a cheese's favorite music?
I don't know, Anthony. What is a cheese favorite music?
R and Brie. I told you it was bad.
I don't know that even
I told you it was bad
really prepared me for the depth of how bad.
Give you the blues?
Oh God, that's so bad. Anthony, you're already leading into my bad news. Or my bad mood this morning because I got fired from my masseuse job the other day.
Oh, I didn't know you even had a masseuse job.
No, I did. It was my side gig. I got fired because apparently I rubbed people the wrong way. When was the last time you made a business decision before asking what it cost in taxes? Shocking statistic. According to the National Society of Accountants 2023 survey of small businesses overpay taxes by an average of $11,400 annually. I just threw up a little bit in my mouth. Reading that. Annually due to missed planning opportunities. Amy Hoy, founder of Stacking the Bricks, restructured her SaaS business mid-year after discovering her tax setup was costing her $40,000 a year annually. She rebuilt her entity structure and payroll model, turning her tax strategy from a cleanup work into growth architecture. Today, Anthony, on How to Founder, we're going to be talking about tax strategy. I'm your host, Chris Franks. With me is Mr. Peanut. We are excited to see you today. I'm kidding. It's Mr. Anthony Franco. We are joined today by Mike Jesowshek. Mike, did I get it? Did I get it right, Mike?
You got it.
Yes.
Spot on.
Pretty amazing. I was thinking, usually I check right before we take you back off. I was like, I forgot to double check.
No, you nailed it.
Oh, that's great. And it's a CPA and founder of Tax Elm, a SaaS platform that simplifies tax planning for small business owners. He spent over a decade helping entrepreneurs legally minimize taxes using IRS compliance strategies and turn complex tax code into actionable growth plans. To start this off and to explain Mr. Anthony Franco's hat, where are you calling in from this morning, Mike?
I am from Milwaukee, Wisconsin, born and raised.
Okay, however, you're not a Packers fan. Explain,
No.
Because I think we could lose any potential listeners right now. We're gonna piss off the Packer demographic. But go ahead.
So nothing wrong with the Packers. When I was young and growing up, the Packers were great. And so, young kid, to get after my dad, I started rooting for the Vikings. And here I am today. And I still say it is my biggest regret. It's the worst team to be a fan of. We're always awful, and the Packers are always great. But here I am. I can't go back. Once you take that dive into Viking territory, you can't go back.
It is quite literally called the sunk cost fallacy, but that's okay. We won't go down the mental hurdles of changing a team's allegiance.
Weird part of that story, my dad was a huge Favre fan. And so once the Packers and the Favre had their fallout, he's no longer a Packer fan. So, I preface this. I knew he was gonna leave the Packers one day, and here we are. But he's not a Vikings fan, unfortunately.
Yeah, something about Mary Brett Favre. All right, Mike. Why do most founders treat tax strategy like a filing deadline, like it's homework. We punt it to the last possible second. We file extensions. We try not to think about it. We try to put it to the last possible second. And yeah, I'm going to guess that usually bites us in the ass. Why do we do that, Mike? Why is it so hard for us to get our head wrapped around tax planning?
That's the $1 million question. And what you're talking about is tax filing, right? So tax planning needs to be done by 12/31. So, the people that are worrying about taxes in April, I said, don't worry about your tax bill last year. There's nothing you're going to do about that because that time's already been passed. Now there's some things you can do during tax season, but most planning has to be done between January and December. So if we're starting to plan when we're filing our tax return, it's already too late. And I often say, let's use that as a tool, as ambition to say, okay, this year we're going to change it. This is the year that we're going to actually do some planning to help lower that tax bill.
I think it's a good place to start, Anthony. How many crappy letters in your life have you received from the IRS? I'm going to guess I'm in the 20 range, 20, 15, 20 range of crappy letters from the IRS.
Well, I don't think I've ever filed. I don't even think they know I exist. So I think I'm fine. I'm totally fine.
What is that class of people like? Oh, I've just decided I'm not going to pay taxes.
Taxation is theft, and yeah, there's a bunch of people like if I really followed that advice, there's a bunch of people that give me the legal strategies around how to avoid paying any taxes whatsoever. Yeah, it does come with a prison sentence, though. But
yeah.
Hey, whatever.
Yeah, Mike, I'll tell you from my perspective. Taxes from the moment I started being an entrepreneur and founder were terrifying. It's the thing that I knew it was always, it's like the monster in the closet. It's scary. It's there. I know it. And I just am constantly worried about it. I get through tax season. I finally pay whatever bill I'm supposed to pay or not supposed to pay, because then I'll get a crappy letter being like, hey, you didn't pay enough. But then I just punt it again. I don't think about it again until that next period of time. I mean, but really, I think that's probably one of the dumbest things I could do as a founder.
Yeah, I think there's a separation and a mindset shift that people need to understand. And there's tax prep and filing. That's required by law. That's just taking information and sending it to the government agencies.
Just note that, Anthony, required by law.
And so when most people think of taxes, that's what they're thinking of. They're thinking of, I see my accountant once a year, I give them all my information and they go pay it, and then I get this nasty bill and pay it and move on to the next year. But that's just one side of the tax equation. The other side is this tax planning, this tax strategy. What can I do to lower that tax bill? And most business owners, most small business owners, most individuals are stuck in the tax prep and filing. That's all they think there is out there. They don't think that there's opportunities for them to save on taxes. And so a lot of the movement, a lot of, what my passion is to say, how do I open up that mindset to let you know, like, there is so much potential for tax strategy, for tax planning, and the government, they're not gonna tell you if you don't do it, but they also encourage it. It's in the law. The Congress writes the law, and these strategies are in the law. And so it's our opportunity to know what's in that law and to implement it. So it's not like the government doesn't want us to save on taxes. It's in the law. They obviously want us to. But if we don't implement it ourselves, they're not going to send a letter and say, hey, just FYI, we implemented the strategy for you because we noticed you didn't do it. Government's not going to do that. So it's our opportunity as business owners to understand what's available to us, and then how do we not only implement that, but implement it correctly. So I think that it's the mindset shift of instead of thinking tax planning as one item, we need to bring in that second item, which is tax planning and tax preparation and filing. Planning saves taxes. Prep and filing is just taking information and sending it to the government.
All right. I want to start from the very beginning of a founder's journey, and let's talk about it and work our way up to bigger and bigger companies. But probably the first decision, I don't say the first, but one of the first decisions I have to make is about legal entity and how I'm going to be taxed and how I should think about that. Anthony and I, we have made literally negative hundreds of dollars here at How to Founder. And so we decide we want to create a legal entity. How should we start thinking about that from a taxation perspective?
We have an amazing retained earnings for the company. Yeah, it's awesome.
Our goodwill is off the charts.
Yeah, so I think when I first talked to a business owner, one is this a real idea? Is this a real business, or are you just kind of like?
In our case, no. This is not a real business.
No,
wait. Stop. You have the balls to ask a founder if what they're doing is real or not.
Yeah.
Do you ever get an honest answer to that? There's not a single founder that's going to say, no, it's not. There's not a single founder that's going to be honest about that question.
I'll give you an idea. We have business owners that come to us, and in my book, I write about this. A business owner said, hey, I'm going to create this crazy new revolutionary tool that's going to change the game of golf. I was like, okay, what is it? Well, I'm still working on like what that tool is going to be, but I'm going to create the tool. And can you help me set up an LLC or a business for this? And it's like, you don't have a business yet. But once you have that prototype, you have that ball that can't be lost and floats in the water and everything else. Okay, now we have a prototype. Now let's start that business. And so, when we're talking to founders, we have to determine there's two kind of routes that we go down. Our traditional route is let's start an LLC. And let's get an LLC set up. It's not going to save us any taxes by getting an LLC set up. But one, as an attorney can talk about, you get the legal protection from the start. And then it makes a solid foundation for your business where it opens up the door for different tax strategies down the road. Maybe we look at an S corporation or something like that down the road. So that's one route. And then if you're in the route where you're bringing out investors, you're planning to have equity investors inside of it, now we might be looking at maybe a C Corp is the route. And traditionally, C Corps get a bad rap because it's double taxation. But the good thing about C Corp is there's tax strategies around that, where if you sell C Corp stock, and there's regulations on what qualifies and doesn't, but there's a potential where if you start a business, you hold on to that business for 3, 4, 5 or more years, and then you sell that business, there's potential that you pay no capital gain tax on that sale. And so that's where C Corps can be super attractive. But C Corps have the downside. And so it's analyzing what is kind of your intentions with this business, what is the goal of this business, and we can always adapt down the road. But let's get a solid foundation in place that not only helps you from a legal standpoint, gets you that protection that you need, but then can also be a growth vehicle from a tax standpoint that opens up the door for tax strategies as you start to grow. So most business owners I talk to, we're starting with an LLC. That's the biggest starting point.
You said something that was a little bit, I think, maybe even controversial or counterintuitive, which is I've heard, and some people will argue, the moment you start spending money in research and development. So I'm creating this incredible new golf swing, golf game, revolutionizing piece of equipment. As soon as I start actually spending any of my own money on that, I should incorporate it. I should have then a checking account. I should have an LLC associated with that. Is that not your advice? Should you wait until you're actually like revenue is somewhere close?
No. I think it's if you're starting to like, hey, the revolutionary tool that I'm going to create is a golf ball that floats. Okay, now you can go start, because now you're going to spend money. You're going to be starting to create different prototypes and work on that. You can start. But if your idea is just, I'm going to create a revolutionary golf tool, and that's the end of your journey so far, you don't have any reason to be opening anything up. So yeah, I mean, you're right. Once you start to have what I say, just a starting foundation, like this is a potential for a business. Now let's get set up. Now, if you do spending and stuff way before that happens, that's okay. You're still going to get the deductions for that when your business starts to operate. But you're right. Like, we don't want to be doing too much without that liability protection before, that business starts to get off the ground.
Anthony, I mean, how many, I don't even want to know the answer about how many LLCs you currently are in, but you started, dozens and dozens, maybe 100 companies. Like, how do you think about the structure, and how do you, when you are first starting, does taxation kind of come into it, or is it something where you just are like, hey, it's an LLC until it's not, which is, I think a lot of founders think about it that way.
I've gone, Chris, I've bounced back and forth on this. Sometimes I'll start an idea and start something, and it's just like I'm just testing the waters. And so I won't put up an LLC. I don't care about taxes. It's just like, is this even a thing? And in that circumstance, don't, like, all the paperwork and operational agreements and everything, is really just a waste of. It's a distraction, but actually figuring out if it's a thing or not. And so no, I don't. And then there are circumstances where I'm like, I'm gonna really. You know what it is? When I decide to make it an LLC, it's more than just taxes, or it's more than just the protection, which you have to consult an attorney for that, and make sure that you don't do certain things so you actually get that protection.
I mean,
But
I don't know why people wouldn't call you wearing a cheese hat on.
Yeah, exactly right.
They just call Anthony.
Yeah.
Think of all the credibility you're gaining.
But what forming it? So there's two things that make this thing real, make a company real for me: the LLC and a logo. And once I have those two things, I'm like, all right, now I'm committed to seeing this through, for good or for bad, for hook or by crook. So it's not just all of those things that Mike said, but for me, I'm committing to the idea, to the concept, to the service, whatever it is, to see if I can actually make it real. I'm going to put real time behind it.
Well, and let me add to that too. When we start to have entrepreneurs that are in multiple different ventures, we'll often look at a completely different setup in that. And so, typically what we say for that, the purpose of an S corporation, right? The reason S corps get their word is when you are in a business, a partnership, a sole proprietorship, an LLC that is just a single member LLC, you pay self-employment taxes on 100% of your income. The S corp, if we elect for an LLC to be taxed as an S corp, we are required to take a reasonable salary as the owner of that company, and we pay self-employment taxes on that reasonable salary. But any income we make over and above our salary, we avoid self-employment taxes on. So let's say you make $80,000 in a single member LLC. We're paying self-employment taxes plus our normal income tax rate on that full $80,000. If we elect that same entity to be taxed as an S corporation, and let's say that a reasonable salary for that is $40,000, we're going to pay self-employment taxes on $40,000, but we're avoiding it on the other 40. And so that can be the power behind an S corporation. And so when we talk to people that are in multiple business ventures that they're active in, so passive, where you're just kind of an investor, you're not doing anything active day to day, completely separate side of the table. But if you're active in a business, we say every person should have an LLC S corp that they own 100% of. And any business that they're active in should be owned not by them, but by their S corporation. And what that means is that, Anthony, if you have an S corporation that you own 100% of, and you own 5 other businesses, 20%, 30%, 75% here, all of those businesses are going to be owned by your S corporation, your portion, and all that income is going to flow through to your S corporation, and you do all the planning on your S corporation. It doesn't affect your partners. If you want to hire your kids, if you want to drive a BMW, if you want to do whatever you want to do, you can do that within your S corporation, and it has nothing to do with your partners. That planning that you do, that tax planning you do, is affecting you, and it's not hurting anything else that your partners might want to do.
Buy more hats.
And then to go with that as well, if you have that one S corp that you own 100% of, you could start a business as just a DBA, where it is just a sole proprietorship, no physical entity structure, but just a DBA that's underneath that S corporation. And then, of course, attorneys will talk to you about this.
Well, you
once
can,
you start
Mike, you
to
can do that with an
generate.
LLC as well. You can start an LLC operating as an S corp and still have the same advantages, correct?
Exactly. Yep. That's our recommended structure. LLC, when the time makes sense, once it makes sense in a profit level to elect S corp status, once self-employment taxes become an issue, then we take that LLC and we just elect for it to be taxed as an S corporation. Still same as an LLC, same name, same EIN, everything stays the same. We're just electing for that LLC to now be taxed as an S corporation.
All right, I have a question for you, Mike. And this is, so we've talked a little bit about underthinking tax preparation and underthinking tax planning. I've been in business with a business partner who, in hindsight, way overthought it. So we had a fairly profitable company together. We also had a captive insurance company, a nonprofit, other business expenses. We had I'm forgetting something else, but we had all of the we went through we looked for tax credits wherever we could, and the weight of managing all of those different tax strategies became so burdensome that it made maybe it saved us a couple bucks, maybe, but it also introduced a lot of risk and introduced just this overhead, this administrative overhead that was a nightmare. Have you come across that where it's like, whoa, you're way overthinking this?
Yeah, I think that there's that potential out there. When we look at tax strategy, it is how do we get this implemented as quick as possible? And so I think that a lot of business owners don't implement strategies because they think it's way too much work. And I would be interested to hear on some of those strategies, and we can dive into that sometime. But interested to hear on some of those strategies, like what was the legwork? Because a lot of it really isn't a ton of legwork. And I can cut somebody's tax bill in half that takes them 4 hours to implement that strategy. That's great. That doesn't cause them any heartache. But yeah, you definitely want to weigh the time. Like if it's going to take you 10 hours to do this thing to save $2,000, is $200 an hour worth it for you? Maybe, maybe not.
Well, it's also the ongoing, the year-over-year maintenance of those entities. Yeah, that was the burden. It was like, oh my goodness.
It was also the only time anybody ever accused Anthony of overthinking anything. Which is the case. But all right, so we've now got early stage. You're overthinking me.
Oh, okay, sorry.
So we've now we're operating, Mike. We've got an entity. We've made the decision. Hear you on the S Corp LLC thing. It's a loophole we can drive a truck through. It's actually probably one of the only really great things about being an entrepreneur. Now we're actually have expenses here, and we're starting to get some revenue and income. How do I start to think about this thing called planning? What are the levers that I have available for me as a founder?
Yeah.
This mysterious thing called planning. What is this?
Exactly.
What is this crazy thing that people
find
talk
this
about?
word called planning? I'm not familiar with the term.
So there's two things. When I look at tax strategies, we break them into two parts. What I call core tax strategies. These are strategies that whether you're making $10,000 a year or $10 million a year, these are strategies that you can implement at any level you're at. And then I have what I call advanced tax strategies. These are typically going to be a little bit more complex, a little bit harder to understand, and these are going to be reserved for higher income earners. Typically, say roughly $400,000 or more in income per year, we'd look at advanced. But regardless of that, we always start with core strategies. And there's a concept that I think is so important for business owners to understand that a lot of our core strategies stem from. And it's this idea of maximizing deductions. And most people say when they hear maximizing deductions, they're like, yep, I've heard this one. Go buy a truck, go buy a piece of equipment at the end of the year, get a big deduction, wipe out my taxes, wipe out my income. But that's not what we're talking about. When we talk about maximizing deductions, we're talking about after-tax spending versus pre-tax spending. And so think of this as like a W-2 employee. You get your gross wages if you're working for somebody, all these taxes are taken out, and then you get your take-home pay. And any spending you do with that take-home pay is after-tax spending. That money's already been taxed. But as a business owner, we have the flip side. We have sales or revenue. We have all these expenses that go into our business, and then we have our profit, and we're taxed on our profit. So any spending that we can do inside of our business is what I call pre-tax spending. And so the concept the mindset shift I like to talk business owners through is how do we move after-tax spending into pre-tax spending? Said another way, how do we take spending that we're going to do no matter what, whether we're a business owner or not, how do we move that spending from after-tax spending into pre-tax spending? And so we look at things like a home office as an example. You're going to have those costs whether you're a business owner or not. But now as a business owner, you get a deduction for some of those home costs. We look at hiring our kids. You guys have kids. We're supporting our kids all the time, right? And so those typically are after-tax spending. We send them to a basketball camp or an amusement park with friends. That's after-tax spending. But what if we could hire our kids to do some work in our business and do it the right way and pay them a reasonable rate for that work? Now we get a business deduction. They potentially pay no income taxes on that. And then they take that money and pay for that amusement park or pay for that basketball camp. And so those are all concepts where there's spending that we're going to do no matter what, but how do we turn it from after-tax spending and turn it into pre-tax spending by finding a business purpose for that? And that's honestly the root cause for a lot of our core strategies stem from that concept and move forward from there.
Well, I want to put a disclaimer up here really quick. And this is, Mike, this is really why you need a professional to help you with this, because you can't just hire your kids and you can't just spend money out of your business for personal reasons without two big risks, right? One, the IRS is going to come after you because they've seen it all before. So it has to be set up correctly and legitimately. And two, you may be crossing that threshold into piercing the corporate veil where now you're you're mixing personal and business together. And if your business messes up, now they can come after your home. So this is where it pays to have somebody that knows what they're doing, that knows what they're talking about as an advisor to your business, without a doubt.
Anthony, I did hire a bunch of my family members, and they fired me, which is weird.
No,
Rick judges a character.
Yeah, apparently I didn't, really understand the corporate governance model of things.
But Anthony, that's 100% right. When we talk about tax strategy, it's first step is learning the strategy. The second piece is implementation, not just implementation, but correct implementation. We need to dot our I's and cross our T's. This is stuff that's black and white in the tax code, allowed, legal, but we got to do it right. Like, you can take the home office deduction. Home office deduction, everybody should be utilizing to some extent, but you can take that deduction and make it illegal just by incorrect implementation. And so oftentimes you'll hear on TikTok, yeah, pay your kids $15,000, just write them a check out of the bank account and, get a business deduction for it. And while that could be the case, there's a lot more to that story that they don't get in a 60-second video clip. And so that's the biggest piece is correct implementation, dot your I's, make sure you have that documentation on file. But it's not that hard to get that documentation on file if it's legitimate.
I have one more question. I have another question here, Chris, because this is really important. So finding an expert is really, really important. But finding an expert is also can be really hard. At least, and expensive. So what should a founder or a seasoned entrepreneur be looking for in this person that they're looking to bring on? Like, what are the interview questions, right? What are the questions they should be asking this person in order to qualify whether or not they know what the hell they're doing?
Yeah, two things to that. One, I think that oftentimes the person that prepares and files your taxes is not going to be your tax strategist. So not most tax preparers are not good at strategy. And that's honestly the reason I got into tax strategies is I couldn't find anybody that could help me with my tax problems. And so I started to learn it myself and fell in love with this game. But I think that's one important piece is that understand that your tax preparer might not be your tax strategist. I think the second piece is understanding where you at in your journey. Are you making $100,000 a year in your business, or are you making $1 million a year in your business? Because that is going to look a lot different. In $100,000 a year, we're doing all core tax strategies. At $1 million a year, we're doing everything we can to core strategies, but then we're still going to have a tax bill after that. And now we're looking at more advanced types tax strategies. And so finding out where you're at in that journey is going to put you into different pieces. I think when you asked about like what interview questions do you ask, I think finding someone that focuses on strategy and understanding that a strategist is going to be different than a preparer is key. And one caveat to that is there's people that promote different products, right? Like you mentioned captive earlier. If you're somebody that is someone that sells or works for the captive company, you're going to say this is the best product out there. That's the best tax strategy ever invented if you work for captive. And so I often caution people that if you're talking to a one-hit wonder, someone that just works for that captive company, you have to broaden your horizon of somebody that looks at it from a holistic picture. Captives can be great, but are they the best and only strategy? Absolutely not. And so having someone that can sit back and annualize and do due diligence on multiple different vendors, multiple different strategies is important than just say a one-hit wonder that says, all I do is captives, or all I do is advanced retirement plannings or defined benefit plans, or, whatever this tax strategy is.
Is this really what a wealth advisor should be doing? Like, if I'm looking for somebody for tax strategy, am I looking for a wealth advisor? Am I looking for a CFO? What's the most reputable kind of person that I'd be looking for?
Again, I think it depends on where you're at in your journey. Wealth, financial advisors, wealth strategists, I would say they definitely are more advanced in tax strategy when you get to the higher level, when you look into those advanced type strategies. But typical financial advisor or wealth advisor generally is not going to be telling you how to properly hire your kids in your business or how to properly do the home office deduction. So
they may have incentives to give you bad advice, right? I mean, they're not held to the same standard as like an attorney, where conflicts are rampant for financial. Maybe I'm wrong. Maybe I'm overstating it, but my perception and my experience with it is like, well, where are you making more money, in helping me grow or from the commissions you get from the positions you're putting me in?
Yeah,
It's very complicated.
I think they have a fiduciary duty to take care of their clients, so they
Yeah,
can't put somebody
whatever.
in a bad product. But with that being said, any product that they place anybody in, they're making a commission on, right? And so, yeah, I mean, it is important to take that into consideration when you're, and that's why it's important to do your own due diligence as well.
Think about that though.
Strategies.
Think about that for a second though, right? So you're a financial advisor and you have two products. One is slightly better for your customer and one is slightly better for your pocketbook. Where are you going to steer them? and honestly, there's no evil intent here. You may steer them towards the one that's better for you rather than better for them. The incentive structures are misaligned with. Sorry, I feel like I'm on a soapbox. So I don't mean to be, but
you rant.
I'm on the rant. I apologize. I'll stop now. I'll stop now.
All right.
Get off my soapbox.
We got to get the speed round, and I want to give you one more, a chance to kind of give us a little bit more advice, Mike. But I want to wrap up this part of the conversation, summarize it the best as I can, which is a CPA is not, like, the person that files your taxes is not a tax strategist. A person that says they're a tax strategist may be a tax strategist, but not for startup founders. It's really important. If I'm summarizing what you guys are saying, it's really important to find the right person that you can sit down with that understands early stage companies and understands your founder's journey. Don't just rely on your buddy who's the CPA that you've known for years and you drink with, which is what I did. So we need to get to the speed round, Mike, but I want to give you one more chance. Like, what other things? So we've now talked about the pre-tax dollars. We've talked about the right way to structure, bring our overall income down. I think that the S Corp 100% owned is brilliant. I never considered it. I'm thinking of all the taxes I paid because of it. What else? What other things do we as founders need to be thinking through on this journey?
Yeah, the first thing we always set is set that solid foundation. Set that foundation for your business, and that's going to be what we talked about. Whether it's an LLC, whatever that entity structure is, set that foundation, and then what does that look like from a tax perspective? When does it make sense to make that way to an S corporation? But then we get into our core tax strategies, and when we talk core tax strategies, we're talking maximizing deductions, after tax versus pre-tax. That's things like the home office deduction, travel. How do we make travel that we want to do anyways, but how do we find business purposes for that? My wife and I, we wanted to go to DC a couple years ago. And so we're like, how do we find a business purpose for this? Well, there's a conference out there. And so we planned our travel around a conference that we wanted to go learn at. And we went to made a tax deductible. We go to the conference in the morning and early afternoon, do whatever we wanted to do afterwards. That was a business trip, but we got to enjoy a city too as well that we wanted to check out. You might look at things like automobile and how do we, turn some automobile expenses into your business. The one thing that I say, every business, regardless of size, whether you're a solo business owner, should have a board set up. That board is going to be people that are close to you, people that you want to bounce ideas off around your business. But what does that also open up? You're going to have board meetings. And what involved in board meetings? Meals, maybe travel, depending on the size of your business. And so there's a lot of opportunities to make discussions and different events with people that you want to be with anyways, but you can make those into a board meeting, get advice from them, get moves there. Hiring your kids, retirement planning. I think retirement planning is a big one that small business owners don't think about, right? They think that their retirement plan is, I'm going to sell my business and make
what is this thing you call
$100 million.
retirement, Mike? I'm not familiar with the term.
And so I think it's important to at least consider it a little bit. Think about the potential there. It provides tax savings. Retirement is something that I say is a tax deferral. You're either, if you're going into a retirement account, you're either saving taxes today, but you're going to get taxed out down the road, or you're saving no taxes today, but it's going to grow tax-free. So it's not necessarily a tax elimination tool. I call it a tax deferral type of tool.
Anthony, and I think this is something we've been hinting around, but let's just say it explicitly. Early stage founders, you need a good lawyer. You need somebody who's going to talk you through this. And these are the things I actually say you need to pay for. Like, I don't go pay for a bunch of stuff that people typically do. Anthony, you agree with that?
Yeah, I totally agree with it. And if somebody's giving you financial advice for free, be very skeptical.
It's sort of like being on Facebook and Instagram. If you don't know what the product is, you're the product. All right, Mike,
Exactly
are
right.
you ready for the speed round?
Let's do it.
We're going to ask a lot of questions quickly. They're not good questions, Mike. They may be good questions, probably not. You know, do your media training, Mike. Just ask the question. Answer the question you wish I would have asked. All right. The most founders overpay on taxes by being too conservative. Agree or disagree?
Agree.
Okay. You find $15,000 deduction in November. Restructure this year to claim it? Question mark.
Say that again.
Yeah, you find a $15,000 deduction in November. Should you restructure your company to claim it?
No.
Yeah, that's a terrible question. Which matters more, lowering your tax bill or increasing your after-tax profit?
Oh, combo. Like, do it together.
Yeah, let's do both. Your CPA says maybe on a legal deduction, should you take it or should you not?
No.
I agree. If tax planning costs 2% of revenue but saves you 8%, when do you start? That's a terrible question too. That's a softball question, Mike.
Today.
Yeah. Good conversation.
I'm still doing the math on that.
It was my understanding that there would be no math.
I was looking for an opportunity to throw in.
I found it. Finally, there was a percentage.
Finally, there was an opportunity to do that. Anthony, what did you learn from today's episode?
So, I mean, there's one, right? I mean, hire an expert. Like, that's it. Don't screw around with this stuff. A couple other notes that I put, company structure, we've talked about this before, has a huge impact on taxes. It can be changed, but it can be painful to change as well. But it's weird, right? Deciding what your company structure should be up front is exactly like asking your kid that's just graduating high school what they want to be when they grow up and pick a major. Like, it's very difficult to forecast where you're going to be. And then the final note that I had to learn the painful way, your CPA may not be a great tax strategist.
Man, I'm not crying. You're crying, Anthony. It's fine. It's fine. Deep dive resources, Tax-Free Wealth by Tom Wheelwright, The Tax and Legal Playbook by Mark J. Kohler. And of course, we're not going to do any of that stuff. You've got a book, Mike. You've got a website. We're just gonna call you. We're going to let you teach us about this stuff. Where can we find out more? Where can we connect with you?
Yeah, 2 spots, taxsavingspodcast.com, or you can check out our software, TaxElm. That's TaxElm.com.
Beautiful. Mike, thank you so much for joining us. You made taxes not suck quite as bad. That's a good thing. I feel slightly better about
That's impossible. He's at least made it entertaining. So
entertaining, exactly. I do feel like now I got to go start a personal 100% on S Corp or LLC S Corp taxation, which, that's feels like it's smart. Should have done that a while ago. Anthony, get us out of here, man. Thanks again, Mike.
Thank you, Mike. Thank you, everybody, for listening. Please be sure to visit us at howtofounder.com, where you can connect with us on LinkedIn and subscribe to us on our YouTube, Apple Podcasts, and Spotify channels. Please hit that subscribe button. And if you enjoyed the episode, please leave a review. Chris, me, Mike, Stephanie, our other co-hosts, we all believe that our listeners are the pioneers of economic prosperity, and we're just truly grateful to be there along the way with you. Thanks, everybody. Take care.